All right, welcome back to another edition of Financial Accounting. Before we jump into the new material, I just wanted to recap where we're at. So we just took exam 3 on Friday. We are now on Monday, March 15th. We're going to start talking about chapter 7. In particular, we're going to talk about 7.1 through 7.5. The first two homework assignments, 7.1, 7.2, we're going to be due tomorrow. 7.3 will take up most of class on Wednesday. We might start talking about 7.4. It just depends. No homework this Thursday. I figure most people are going to be heading into town trying to make the most of their spring break. So there's no point in having you guys work more than you absolutely need to, but just realize that you will have 7.3 homework due next Sunday. We'll continue on with 7.4, 7.5 next week, and then start talking about chapter 8, which is primarily about intangibles. Our next exam is going to be Friday, April 2nd. So you want to make sure that you are staying on top of your reading. Read before you come to class. Make sure you attend every class, pay attention, and get that homework done. Ask me questions if you need help. So after we're done with exam 4, exam 5 will be a quick turnaround period. It's only a little bit of part of Appendix F, and really Appendix F, the first couple sections, which we'll talk about in class, of course. 9.1 through 9.3. So chapter 9 will be a pretty short chapter, mostly related to bonds and interest amortization. That's kind of a heavy conceptual load. So but that will comprise exam 5. Then we will have, come after exam 5, we will have chapter 10 to get through, 10.1 through 10.4, and then 11.1 through 11.3. So we're going to kind of thin out here, and then we get our final exam. Realize that this schedule, the tentative schedule, is up on Blackboard in the course administration folder. So make sure you're paying attention to the dates as we go ahead. You'll see that on April 20th, the accounting cycle extra credit project is due. That is up on My Accounting Lab. Let's take a quick look there. You'll see on My Accounting Lab the extra credit project, estimated time about 400 minutes. This one is mostly just busy work. There's 11 modules. Each module gets you a practice run through all of the quiz questions. The quiz questions in each module are all one attempt each. So my recommendation is start to tackle this as soon as possible. Start going into the first module. You'll see it primarily covers chapters 1 through 3 with heavy emphasis on chapter 3 mostly. So not too arduous. It's just presented in a way that's slightly different than you're used to on the homework and exams. Chapter 7 and chapter 8 homework is up there on My Accounting Lab. So dive into those and get those taken care of as soon as possible. Without any further ado, let's jump into chapter 7. Chapter 7 is mostly about what's called fixed assets or plant assets. So sometimes you'll hear me use the phrase instead of plant assets. Sometimes you'll hear me use the phrase fixed assets or long-term assets. Another quick phrase I like to use for those is PP&E for property, plant, and equipment, or otherwise known as tangible assets, tangible long-term assets, assets that you can physically see and touch and smell and taste, et cetera, et cetera. So that's what we're talking about here. So first, 7.1 talks about all the different costs that go into acquiring these types of assets. Now, what you'll see here as a general rule for measuring the cost of any asset is the cost of any asset is the sum of all the costs incurred to bring the asset to its intended use. So in the case of chapter 6, we were talking about inventory. Realize that, hey, we had the purchase price of the inventory, but there was taxes and fees, tariffs potentially. There was also maybe if there's some sort of sales commissions. We didn't really deal with that in chapter 6, but in the case of chapter 7, if we have an agent that works on our behalf to go find us plant assets, we would pay them. Basically, any costs we incur to get the asset ready for use. It's similar to inventory capitalization. We'll talk about that word often in chapter 7 and 8, where we're basically capitalizing, not expensing, but capitalizing the costs we pay for shipping, taxes, fees, etc. So in the case of most every asset, if we spend money, the cost to get the asset in place, ready to be used, those are not expensed right away. Those are all what we call capitalized, or they show up as an asset, not an expense. So one of the most common types of assets you see in most corporations is asset for land. And land is not depreciated. It's basically just left on the books at whatever we paid for it, plus any commission fees, survey fees, legal fees, property taxes, any type of fees and taxes. I would say these all kind of go hand in hand. Expenditures for grading and clearing land. So if we have to get the land ready for use, there's a bunch of crap on there. Maybe it's not leveled. We need to get it leveled. If we spend money just to get the land ready to be used, that's all capitalizable. That's all part of the T account cost for land. So we're just taking all these costs here and we're plugging it in as a debit to land, not as an expense, as a debit to the land, removing any unwanted buildings. If there are buildings on there and we decide, they're just in the way and we have to destroy them, the cost of bulldozing those buildings also gets included as part of the cost of land. So for an example, we need to see examples because on the exam, especially for exam number 4, you got to be able to identify which costs to capitalize and which costs don't get capitalized or have to be capitalized as something, a different type of an asset. If we're just talking about what goes into the T account for land, we have to be very, very careful here. Okay. So FedEx signs a $300,000 note to purchase 20 acres of land. Okay. FedEx also pays $10,000 for commission fees, $8,000 in property taxes, $5,000 in removal of an old building, and $1,000 in survey fees. And they also paid this $260,000 to pave a parking lot. Okay, is that really part of the land? Do I spend that much money to prepare the land? Or is this something separate? That's what you have to ask yourself when you're doing these questions. So, purchase price of the land, $300,000. All the individual costs, $24,000. So the sum of that is $324,000. Note, the parking lot is a separate asset. We're going to treat that as such. So we want to be careful here. Which costs are necessary to get the land in place and ready to be used? Once the land is ready to be used, we can put whatever we want on the land, like a parking lot or fencing. Those are things would be separate from the land. So here we're just talking about what are the costs for the land versus everything else. So down below, here's that 324 we just summed up. We want to not expense it right away. We want to debit the land for the 324. That's what we saw up above. Well, what about the parking lot? Parking lot is going to have its own asset account. That 260 is going to be set up as a separate T account. So down below, we just want to make sure that the 324, part of which we paid in cash, the other part was from a borrowing, that all gets included as the land account. The parking lot is a separate beast altogether. If we put the parking lot on the land, realize we had to get the land ready in the first place. And maybe we didn't want to put a parking lot on there initially. Maybe we didn't know what we wanted to do until we got the land ready. So realize when it comes to figuring out the cost of a long-term asset, we want to focus on all the costs that are necessary to get it ready for use. That's the key thing there. I got my thing on here. Get the sucker down. All right. So that's what we're talking about in that case. So you have to be able to distinguish the cost to get the asset versus all the other types of costs that either will be capitalized as something separate or maybe expensed right away. What about the cost of a building? So in particular, if there's already a completed building and I say, hey, I like that building, give me that building. What are all the different costs that would possibly go into the T account for the building, right? So purchase price, obviously, commissions, agency fees, things like that, taxes, legal fees, any type of fees or taxes. Usually we got to put those things into the building account. We don't expense those right away. We will credit cash for these things. Oftentimes we use a notes payable of some kind. But in this case, really the question comes down to what's the debit? Expenditures to fix and or renovate the building. So oftentimes when we move into a new building, one of the first things we get rid of is the carpeting. Carpeting is always just nasty and moldy and gross. So all the cost is to get rid of stuff, even to dump it, take it and get rid of it. Those costs are all part of the building. What if we want to just build a structure from scratch? Build me a building. Cost of structure includes what? Architecture fees, building permits, contractor charges, material and overhead. I mean, all these are what we have to spend just to get the thing in place. But also here is another key thing that people tend to miss in the exam is if we borrow money to finance the construction, the interest on that money borrowed is part of the building cost. So the building itself, we got fees, we got permits, right? If you've ever built a house, this is just ridiculous. All the fees and all the costs that go into building the thing. But also, if there's interest, we're not going to expense that right away. We'll include that as part of the building. Ordinarily, when we borrow money, typically we just debit the interest expense. But in this case, the FASB says if you had to borrow that money to get the building up and running, you can go ahead and capitalize that. There are some special conditions that apply, but that's the one I would just sort of be careful for, watch out for on the exam. In the case of equipment machinery, again, think about inventory capitalization rules. When it comes to buying equipment, there's the purchase price, less any discounts, transportation, freight in, insurance, sales taxes, tariffs, etc. All these things, this is very typical. This is similar to inventory, right? Inventory capitalization. Whatever it costs to get the asset, we just go ahead and include that. If we use a brokerage agency to help us find the equipment or help us build the equipment, installation costs and expenditures to test the asset before it's placed into service. We want to know whether it works. So even if we spend all this money to get this thing up and running, we still need to test it and make sure it can handle the workload, right? In that case, all the money to test it, as if it's necessary, especially to get it into place, that is all capitalized. So we're talking about computer equipment, we're talking about brewery equipment. All these costs are going into just getting the asset in place for the use. Once we're using it, we stop capitalizing. We just start debiting expenses for maintenance things. So here's one in particular, costs of any special platforms. So I used to be a home brewer, and one of the places I loved going to was St. Arnold Brewery. And St. Arnold Brewery is owned by Brock here. He's a great guy. He's very helpful to get you up and running if you want to start home brewing. He's very nice, very approachable guy. There you see him standing next to all these tall fermentation vats. And these fermentation vats are very, very heavy. So you see in this picture here that they've got this sort of like this grayed out kind of or tealed out bluish green sort of area. This is platforming right here. In the case of Brock's Brewery, when you've got these vats, some of them I see up as far high as 2 stories high. These things are very, very heavy. This is where all the wort, W-O-R-T, goes into in the fermentation process. The wort goes in here, people sprinkle in the yeast, and then the yeast starts producing beer or alcohol, basically. The output from the yeast is alcohol as well as CO2, and there's the airlock system right there. It's a bucket full of water too. All the CO2 is just popping off out of that vat. These things are heavy. These things are wicked, wicked heavy. And so you can imagine that we can't just move into a place and just say, oh, there's concrete already there. Let's just put in this, 500 tons worth of beer on the floor there and just hope it doesn't fall through the concrete. No, what we have to do is potentially reinforce the platform. So that's just to get it ready for use. That's also part of the cost of the equipment. It's not part of the building itself. It's part of the equipment. It's not part of the land. It's part of the equipment. The term equipment, you'll see this on the exam and even especially on the homework, is it's used as sort of like a general term. It can also include things like vehicles. Sometimes you see it as machinery. Land improvements. Now, this is where kind of harkens back to the FedEx example earlier. There's the cost of land improvements that can also be capitalized rather than expense. So we talked about driveways or parking lots, right? Those will be a separate account. Signage, fencing, sprinkler systems, these are all going to be their own separate T accounts. We're going to have multiple T accounts for whatever, driveways, signage, sprinkler, right? So that we can have all these separate T accounts. We want to keep these things separate because we want to keep track of how much these things cost because, hey, if we have to do some sort of down the road, if we have to replace these things, we want to know at least how much it costs us to get those things in place. Those are separate from the land. Land is separate from these costs. There's going to be something separate here. So key thing to remember is don't just include everything we spend in the T account for land. Um, Land can be used for multiple things, but generally speaking, things like sprinklers that are installed are going to be separate from the land, and fences installed are going to be separate from the land, just as we talked about above there. The key feature here is that we want to preserve the cost basis of the land. We don't want to muddy up the T account for land because eventually we want to sell it. And when we do sell it down the road, right, that's the cost basis. We want to know when we sell it, hey, we get rid of it for some amount, how much in cash did we get? Was it the same as what we had as a cost basis? Was it more? Was it less? We won't really know that if we have a T account that includes a bunch of erroneous crap in it. So land has got to stand by itself and say, here's all the costs to get the land ready for use. Regardless of what we put on the land itself has value. So we need to preserve that land T account. So that way later on when we sell it, we can figure out if we actually made a profit on it. Some of you guys lease or rent apartments or houses. Believe it or not, you can make improvements as long as the landlord approves. You can make improvements to your house or your apartment, and the cost of those improvements generally are considered fixtures. So in the case of, hey, we wanted to install recessed lighting, or we want to paint it, or we had to widen the doorway because one of our tenants, say for instance, uses a wheelchair, things like that. Those are all considered fixtures because when those things are inputted into the rented facility, those are things you can't take away. They're fixed to the actual property itself. I had some college students who rented a house, and they had this kind of sloped, sort of like grassy thing that went out to the street. And what they wanted to do, they contacted their landlord and said, hey, can we create a raised flower bed right here? And the property owner said, yeah, sure, go ahead. So they went to the trouble of putting in a flower bed. Now, here's the thing. They can't take that with them. I mean, it's an improvement to the rented property. That sticks with the property. But they wanted to do it because they just felt like, hey, it would just make living there really nice. Those costs can sometimes be recuperated through lower rent. But generally speaking, the landlord would just say, hey, that's on you, not me. So in that case, we would just have what's called just a leasehold improvement account, or we spend all this money on just trying to beautify the place. The downside is we don't get to take it with us. So it's like any other type of asset. We're going to go ahead and depreciate it. But usually we depreciate over the term of the lease. So if we make an improvement to say like the flower bed, and let's just say in general there's a 10-year life associated with that flower bed. If the lease only goes for 2 years, realize we got to depreciate that over 2 years because when we move out, it's going to be someone else's flower bed. So the idea here is you can put whatever you want do whatever improvements you want, but you have to ask yourself, how long am I really going to be living here in this house or this apartment? Is it really worth it? Right? Because at the end of the day, if I'm only going to be there for 2 years, I'm only going to get 2 years worth of benefit from this leasehold improvement. So you got to be careful when you're doing those types of things to rented space. Here's one I always ask on the test, and that's the lump sum or basket purchases. So in the case of a lump sum basket purchase, it's essentially like buying in bulk, where we want to buy several long-term assets for a single lump sum amount. And when we do that, it's kind of like Costco. If we buy in bulk, there's going to be a discount on each item for buying a bunch of things. Now, sometimes we're buying things more than we actually want, but we're still getting a good price, or like, screw it. It's a good deal if I buy in bulk, right? That's how Costco made such a killing in the bulk commercial business for individuals. Total cost is going to be divided among the assets, but how do you do it? It's going to be based on what's called the relative market values. We're going to go through an example so you can see this. So you want to pay close attention here. It's oftentimes called the relative sales value method because the sales value approximates what's considered market value. But when we buy it, we're not paying market value. We're actually paying a price that's somewhat less than the market value because we're buying in bulk. That's the whole idea here. So if, for instance, we buy land and a building, right? Maybe we wanted the building, but the seller said, "Hey, I'll throw in the land also for you if you buy it." And we're charged a total bulk amount of $2.8 million. So 2.8 million we pay, we get land, and we get a building. Fine. When we buy this, we have to figure out how much we're going to allocate to the land and how much we're going to allocate to the building. In order to do that, we need to know the market value. So an appraisal value or market value, when you think about appraisal, think about market value. Appraisal indicates that land's market value is $300,000 and the building's market value is 2.7 million. So if you plug those things in there, there's your land, there's your building. If you sum those things up, you'll see that the total market value is actually $3 million. So we actually got, in this case, we had a savings of $200,000 because we bought in bulk. So again, think about Costco. I'm buying extra stuff, and in doing so, I'm paying more money than I actually want. I'm spending more money than I want. So therefore, the seller got to give me a break. Give me a break on the cost overall. So essentially, what I can see here is I'm saving myself $200,000 by buying in bulk. But how do I allocate? I didn't pay 3 million, I paid 2.8. So I paid 2.8 for two things. How do I allocate the 2.8 to the land and the building? Should I allocate half to each thing? Should I put 1.4 as the land and 1.4 as the building? No, that doesn't sound like a good idea because the land is worth 300,000. So we don't want to put a T account, create a T account for land of 1.4 million when it's actually only worth $300,000. And if the building is worth 2.7 million, I don't want to put in a T account value of 1.4 million. That doesn't make sense either. So the dilemma here is, how do I allocate the 2.8 across the land and the building? This is the setup. Here's what the FASB says we need to do. In the lump sum basket purchase, we first use the market data to determine each asset's relative market value, which is a way of saying what's each asset's market value as a percentage of total market value. In other words, what is 300,000 as a percentage of 3 million? Well, this is the total market value, and we just sum those up to get the 3 million. But what is 300,000 divided by $3 million? Well, that gets us 10%. On a market value, from a total market value basis, the land represents 10% of the total market value. And that means the building represents 90% of the total market value. So I'm sort of like looking at the market data first and figuring out, well, if I were to buy these things separately, how much would I pay in total? 3 million. I'd pay 300,000 for the land, 2.7 million for the building. 300,000 represents 10% of the overall market value. The other 90% is to the building. So once I figure that out, then the second step is to multiply the relative market value percentages by the actual price paid. So I'm going to take this 10% and multiply it by 2.8 million, and that gets me 280,000. Take this 90%, multiply it by 2.8 million, that gets me 2.52 million. And those represent 10% of the overall cost paid. I'm using the market, the relative market values to allocate the total purchase price paid. So in your book, now that's just how I tend to like draw it out. And I'm doing these types of problems. It helps for me to draw things out. You guys know that by now. The book kind of gives you this sort of long drawn out equation, but you can see what they're doing here is the same thing. They're saying the total market value, 300,000, 2.7, 3 million. They're just using that, the 3 million as the denominator. When they're dividing 300,000 by 3 million, they get 10%. That's the relative market value. They just multiply it by the total cost to get each asset's relative cost basis. So I'm doing it in a sort of a visual pictorial way. The book is kind of doing it in sort of like a mathematical equation way, but I think you have to see it. You have to kind of like draw it out in a way that makes sense to you. So just providing you an alternative perspective on this. The bottom line is we have now this allocation of the 2.8 between the land and the building. So what is the journal entry now? Well, the cash is going to be for the full 2.8 million that we paid, but we're going to split that between land of 2.8 million and the buildings, or in this case was one building, 2.52, and then we plug those in as their own separate T accounts. That's what the FASB says is, relatively speaking, that's how much it would cost you if you broke out the purchase price between the land and the buildings. And that seems fair. But we have to use the market data first to determine those percentages and then move on to the multiplication. One thing I want to keep in, I think we need to make this clear, is that it's oftentimes people think that the $200,000 of savings is actually a gain. I mean, it's true that there is somewhat of an immediate market gain when we buy in bulk, but in the case of accounting, we don't recognize this gain right away. Okay, it's not really a gain anyways. Right now, it's just a savings. If there is a gain, we're only going to recognize that when we sell the asset down the road. Okay, who knows what we're going to get when we sell it? But the bottom line is this: we buy things in bulk. We have cost savings. We credit cash. We debit the asset accounts. There's no gain that we actually show in our financial statements. We could say that there is an economic justification for recording a gain, but there's no way we can, as an accountant, actually recognize this in the financial statement. So just be aware of this, that yes, we're saving money, but it's not really considered a gain, it's just savings. 7.2, they talk about distinguishing between capitalizing versus expensing. So before we can in order to clarify this, we have to sort of first talk about what an expenditure means. An expenditure essentially means money spent. Okay, it means we credited cash. That's what an expenditure means. Expenditure, expense, it sounds the same, but those are two different things. An expenditure means we spent money. Credit cash, but what's the debit? That's what we're asking here. So if we spend money, we credit cash. What do we debit? Two options. Usually it's an expense for things that we consume immediately. So imagine we go to a movie, we watch the movie, haha, that was fun. And it's too bad Iron Man died, right? We had a good time. That is something that we expense right away. We would just call that entertainment expense. And that would show up on the income statement. Why? Because that was cash, an expenditure that we consumed immediately. That's why it's debiting the expense. What if we're spending money on something that we're going to consume over time? Well, imagine in the case where we prepay our Netflix account, right? At the beginning of the month, we prepay Netflix. Hey, we're going to enjoy movies for today, tomorrow, and the next 28 days. So does that mean we have consumed it all right away? No, it's an expenditure. It's an expenditure that is being, in this case, capitalized. So we call that capitalization when we put it on the balance sheet as an asset, and then over time we consume it. We shows up as an expense. So key thing here is, yes, in general, the costs that we spend to get the asset in place, those things are capitalized. But after the thing is in place, generally we just expense things as we go. So when we capitalize an expenditure, the money spent is added to an asset account. Usually it's some type of long-term asset, maybe it's short-term, rather than being expense. Cash is going down, another asset's going up. Essentially what we're doing is the capitalization process exchanges cash for a different type of an asset. We're swapping cash for something else of use. So in the case of we buy a truck, there's a purchase price, there's taxes, there's registrations, all kinds of things, right? We would debit the long-term asset vehicle account, or whatever we want to call it. Credit cash, that's the expenditure, right? After the asset is in place, and this is a key thing, after the asset is in place, ready to be used, and let's say it is being used, any new expenditures are usually expense, not capitalized. So in the case of oil changes, right, we would just call those expenses, maintenance expenses. That would show up on the income statement. that wouldn't be something we capitalize because there are certain rules about capitalization. All the money to get the asset in place is capitalized. Thereafter, typically expensed. There is one exception, though. First, we need to sort of compare these two. Expensing things related to our vehicle or any type of long-term asset. Generally, we're using this thing. Expenses occur for things like ordinary repairs, transmission repair, oil changes, replacement of parts that wear out over time, like windshields, tires, etc. Those things are typical expenses. Those are typical repairs and maintenance kind of things. Those are just expensed. Is it possible? Is it possible to capitalize an expenditure, though, after the asset is being used? And the answer is yes, but only in very strict circumstances. If the expenditure extends the life of the asset, we can go ahead and add it. So imagine we got this truck, right? Or a vehicle, and it already has an amount in there for what we spent to get the truck. If we spend additional money to extend the life, we would go ahead and put that as a debit to the truck account, not the expense account. If it improves the productivity or the usefulness of the asset, we can go ahead and capitalize that as well. So in other words, capitalization means increasing the asset's usefulness after it's in place. And this can happen in the case of extraordinary repairs like an engine overhaul. Maybe we put in a stronger engine. Generally speaking, you put a new engine into a car, it's going to make the car last longer. It's going to extend the useful life. Body modification. So if we have this truck, let's say we put on a hydraulic lift system, or we somehow increased its storage capacity or its fuel efficiency. These are things that we can go ahead and say, these things need to be capitalized as an asset. It should not be expense because these will provide value. It will consume the value over time. This isn't just a one and done type of thing. We're going to get the benefit of the engine over the next, say, 7, 10 years. Same thing with the hydraulic lift system. We're going to get the benefit as long as we use the truck. But things like oil changes and typical repairs and maintenance, it's arguable, but generally speaking, those things are just expense because those are typical. It's expected to wear out over time. Those things should just be expense. And by the way, let's not get it twisted here. You can put some dubs on your truck, right? Put in a nice sound system. That doesn't necessarily mean that the truck's usefulness has improved, okay? We're talking about objective. We need to be objective when we're making these decisions. So those are all the notes I have for 7.1, 7.2. A couple things about the exam. As a lot of you know that the average was about 68%. About 2 people get 105%. Another 2 people get 100%. About 27 students got 90% or higher. One thing I want to just sort of mention is there is a significant positive correlation between your exam score and your homework scores. So make sure you're doing your homework. It's absolutely crucial that you apply the concepts that you learn in this class to the homework. That's the purpose of the homework. Also, keep in mind this too. Some of you are burning through your attempts when you're doing the homework. I don't recommend that you do that. Okay, those people who have a high rate of success on their first attempt tend to do better on their exam. So if you're a person who's burning through all of your attempts, you're kind of not learning the material very well. You may think you are, but you're not. So the key thing here is just realize that you need to read the book before you come to class, and you need to attend class and pay attention. This is where you solidify the material in your mind, and this is where you practice, is on the homework. So treat the homework as a way of testing your knowledge or testing your readiness to take the exam on the material. That's why I give you so much homework. It's not to beat you up, right? It's 2 points each. You don't complete it all the way through. That's understandable, okay? But the key thing here is you take the homework seriously because it is a statistical fact that those who do well in the homework and take the homework seriously, those people tend to do better on the exam. But if you don't, if you're still struggling, hey, fourth thing is you got to consult with me. Talk to me about your exam. Talk to me about your study habits. Let's figure out a way to get you up to speed, help you pass the class. Realize that there is no SI sessions here, right? So if you're doing other things like you go online to watch a YouTube video, right? Or you go to an SI sessions. Those things aren't required. What's required is that you read, you attend class, you practice, and you consult me to get this in your head. You do extra work, you're basically wasting time, in my opinion. So talk to me if you need help. That's all the information I have for today's class. If you have any questions, please let me know.